All right, welcome to the Risk Reversal Podcast. I am Dan Nathan. I'm here with Michael Dempsey. He is a partner at Compound VC here in New York City. He is returning to the podcast. Michael, thank you.
Thanks for having me.
All right, you and I back in June had this great conversation. We were talking about AI, autonomy, a bunch of themes that you've been investing in for a while. I think you first came on the podcast maybe 2 or 3 years ago, and this was not a sort of Johnny-come-lately thing for you. You've been looking at, the evolution into what a lot of investors have just been talking about AI rather than differentiating a lot of the different technology and how it's going to work within not just the tech space, but in industries outside of it and disrupt. And you've been involved in some really interesting names, and we're going to talk about them. We're going to talk about a new fund that you are closing on, going to be an interesting structure. I'd like you to explain that and why you're choosing this structure. You're still focused on crypto. And by the way, we had a guest coming in, a young friend of mine named Evan Karvounis, who's been in the crypto space for 4 years while he's in college. And I wanted to have him on to talk about what he sees as some of the big narratives right now, but he's also involved, and you and I just put this together, in the Hyperliquid platform, but also, I guess you'd call it the token, which is Hype.
Yep.
And you're involved in that. And so we just said, let's converge these things. And so Evan's going to be joining us in a little bit to talk about that. But Michael, really quickly, let's remind our listeners about Compound and your background too, because you've lived and breathed tech probably as long as you've been an adult and maybe earlier for that matter. Yeah. And you got into investing, which might not have been exactly the logical thread when you started following technology, probably 15, maybe 20 years ago as a teenager, that sort of thing.
Yeah.
So let's hear about your background in Compound really quickly.
Yeah. So my career started on the hedge fund side, trading long, short, largely tech, trading volatility with options on delta neutral, and then doing some private equity work, and then eventually seed stage investing, built out a team at a startup called CV Insights, and then have been helping build Compound for the past decade now. What we do in a very simple framing, we call ourselves a research-centric, thesis-driven investment firm. Mm-hmm. We take a very prescriptive view of the world. We take academic research that we do firsthand and spend time with a bunch of academics and people within R&D groups within big labs and say, where do we think the world is going on 10 to 20-year time horizons? Historically, we've done this at the seed stage, being like first institutional money in, leading seed rounds, and have alongside of that always done a fair amount of liquid crypto investing as well out of the same vehicle. Mm-hmm. And now we've also been expanding into public markets in areas such as machine learning, robotics, biotech, healthcare, and just the way all of these technologies are kind of cascading through markets and the world, and doing it in kind of a long duration, long time horizon framing.
Yeah, and I want to get into some of those sectors that you mentioned, because right now in the public markets, we're seeing, at least maybe there's a disconnect between the price action in the markets and what's going on with the companies fundamentally. And I think that's something that we like to spend a lot of time on, because, you could be, just kind of really immersed in the technology and head down and building and all that sort of stuff. And then you could literally be just, like what's going on in the markets. And we'll talk a little bit about software, but we've also seen some products released by some of these labs that is really hitting, some areas of the market that it just kind of took people by storm a little bit. One thing, when I said you started out in, you were obviously always interested in technology, but being a vol trader and that sort of thing, that's what I meant is kind of not particularly intuitive, because I started out as a long short equity guy, and then I moved into vol trading. I was out last night with a bunch of the guys I used to work with on Merrill's equity derivatives desk, and these are all brilliant guys, MIT, Harvard, and they learned, how they actually transaction in the markets had not anything to do with fundamentals or catalysts or, relative valuation, all that sort of stuff. So the fact of your path is really interesting to me. All right. Where do you want to start? I'd love to talk about your fund structure a little bit, because you said you're taking these long duration views. You're digging into, these huge technological shifts, but themes. And, if you're looking too short term, you might lose the forest for the trees a little bit. So let's talk about your style and where you are is thinking about, we'll do the crypto stuff in a little bit, but where you are as far as AI right now.
Yeah, I mean, I think stylistically, we say what is happening at the bleeding edge of any industry. And I think the main thing we've learned over the past decade has been the time horizon from research to commercialization of that is compressing materially, to the point now where venture investors are funding research labs with hundreds of millions to billions of dollars out of the gate. And so that's kind of eroding or competing with academia and the role that they've played in markets historically, which is government funded / endowment funded research. And now it's, venture capital funded research. What we then say is, where is there going to be durable value accrual? So I think maybe that durable part is the thing to focus on the most. Right now, I think a lot of people see parabolic ARR ramps in a bunch of businesses on the private markets, and they are terrified of the erosion that could happen in public markets. And I think that our view is some of these things are very real, and people are like really sleeping on a bunch of the shifts that will happen. And in our annual letter 2 years ago, we published and wrote, the past decade of technology was about market cap expansion. Like technology ate the world. We have $4 trillion businesses. The next decade is about market cap destruction, which is the turning over of large amounts of companies. And if you look at, there's a very famous chart that people like, which is the replacement rate in the S&P 500 over time. And like that replacement rate has come down materially over the past 50 years. That could possibly only change more. And so our view is, with all of these things happening, you have to have very reasoned understanding of not just the first order of, a new AI model means that lawyers might be, displaced for a certain amount of dollars, but also what are the second and third order effects that create like durable businesses. And I think the thing that we've seen is doing at that seed stage was about understanding complex technical things and modeling out, how do these scale over time? How does improvement in technology make its way into markets, into products? I think now, what we've seen probably in the past 5 to 6 years is these changes and that compression of time meaningfully impacts the largest companies in the world. And if you look at the areas where we spend time, you have to understand both ends, because maybe for the first time in history, the most innovative companies in the world are actually the largest ones in technology: Meta, Google, NVIDIA, Amazon, Apple, et cetera. Debatable on some of them. But the second order thing is that on some of the other areas, like biotech, for example, they are the biggest companies are the least innovative, right? They spend very minimal amounts of R&D. And so if you believe that there is a seismic shift in value capture, there's a lot of places to play, and the things that we see at the earliest stages really directly translate. And I think that is paired with also just this idea that people are chasing rotations and narratives more than ever in markets, and that's why you're seeing such parabolic moves. So we can talk a lot about that from like a vol lens as well.
Yeah, I mean, it's interesting because within the public markets, you've seen this kind of rolling themes. It started picks and shovels, and NVIDIA then was the only game in town for GPUs, and then it got obviously the hyperscalers, their biggest customers, and then it got to the folks that make the servers and the racks, and then it was now it's memory and storage, and it was neo cloud. That sort of thing. So you've seen these rolling themes, and they don't seem particularly like, if you're a tech, follow tech pretty closely, you can put all the components, and then it was energy, that's just, so you could put them all together, and I think the markets, or at least investors' appreciation of those, there was trillions of dollars of accrued in the first stage in 23, 24 into 25, but then it really stalled out a bit, and semis have been shown great relative strength, but there's names within semis that actually go sideways or just haven't acted particularly well. So the software has been the big focus, and I just want to talk to me a little bit about this. So if most of the innovation now is within the labs and the private markets and the models that they're pushing out, right? And then how they're going to be adopted or who they're disrupting, that seems to be the story right now. But there's also this situation where in the public markets, you have this mark-to-market nature. Yeah. And you're going to be able to see this destruction real time. And we're seeing that, but maybe it gets overdone. Who knows, right? But in the private markets, do you think there's not enough attention put on the fact that you leave DeepMind and you can go and raise, $100 million at $1 billion valuation pre-product or something like that. Or you have, OpenAI over the last year raised at 200, then 500, and they're looking to raise at 750 now, that sort of thing. And that seems out of whack with what we're seeing in the public markets. So just give me the 411 on that, how you're thinking about it.
Yeah, I think there's a few things, right? There's the kind of first order thing is like, what is the industry structure? The industry structure is lots of dry powder, lots of people who are incentivized to deploy money at scale as these firms scale, it's much easier to write $100 million to $500 million check.
Can I ask you a question really quickly on
Yeah.
that? So it seems like the VC community is participating less and less as the numbers get bigger and bigger.
Yeah.
And then what's happening, and Anthropic's a great example, or OpenAI. Well, OpenAI, let's just talk about this for a second, is like their biggest customers are the ones who are going to be the anchors for this round. So does that make you feel, more bullish or less bullish about what comes next in the near term? Because it seems like those companies, whether you're, Microsoft and Amazon and Google and Nvidia and SoftBank, they need this to keep going.
Yeah.
And if OpenAI can't raise that $100 billion, then the whole thing really hits a big snag.
Yeah. There's a saying that we talked about in our AGM last year, which is, I'm going to butcher it, but it's like, I would rather live believing that there is a God, or live believing that there is a God and die to find out that there isn't, than live believing that there isn't and die to find out that there is. And I think that is what most people in AI today on the corporate side are, which is you have a couple $1 trillion of market cap that is sitting, waiting to say, if this AI thing works, then you could have $4 trillion businesses become $8-10 trillion businesses. And if it doesn't, and you time it, everyone else mistimed it too. And so maybe from a relative basis, you get killed less. If it does and you don't play the game, then you're dead. And so I think that everyone is kind of forced to full send into this theme. And I would say that Satya and Zuck were probably the first people to very publicly say that and say we have to overinvest. And obviously Satya has maybe pulled back and then moved forward again a couple times in the past few years, which shows, I think, some sort of reasonable take in the market for Microsoft, but it is pretty existential. And I think for me, I am, merely a simple-minded small investor. I prefer financial people to set prices, not strategic ones.
By the way, you're the farthest from simple-minded. You're one of the brightest guys I know, not just in markets, but obviously technology and the like. So,
but yeah, I prefer financial people to set prices, and that's not happening too much anymore. And I think that the disconnect in private versus public is very easy, which is in public markets, hundreds, if not thousands of people are setting the price. In private markets, 1 to 2 people are. And so you need to just have someone who's incentivized enough to your point, keep it going. And I think that some of it might look incredibly prescient. I think, a good example is people early on looked at Thrive and thought what they were doing with OpenAI was crazy. And I think that's now looking like one of the more prescient investments, especially how they structured it, to have the ability to buy at a similar price to when they invested within 12 months because they stepped up. And I think some of the people that invested in Anthropic now also look like geniuses, despite people saying, what are you doing investing in the number 2 player back in 2024 at $60 billion? And that's a $350+ billion business that's arguably executing OpenAI now. And so, I think as with everything, there will be the vast majority of things will die off and, a few will succeed. And to your point that people have talked about on this podcast, OpenAI I think has tried to create a dynamic where they're too big to fail. That personally rubs me the wrong way, but it's incredibly, I just think that that's a few of the things they've tried to talk about publicly, probably most notably when their CFO said, there might be some sort of government backstopping that needs to happen, I think is a very non-tech Silicon Valley capitalism type mindset of the things that need to fail, and the things that don't, do it out of merit, which is again idealistic in some ways. But I think regulatory capture in its own way is a bad thing, but everyone in AI is trying to do it in some form.
Yeah, and that whole idea of state capitalism, we've seen, the U.S. government take stakes in companies, and Intel was obviously, important one within the tech ecosystem, and I get the reasons. I mean, they already got the money from the CHIPS Act, whether it turned into an investment or whether it was just kind of, the idea that we need to build fabs here, but then you pick the worst company to do it, who has had no success literally for 20 years. They go back and forth, or they have, whether they would be good at building factories to make chips, and they have not been successful in doing it for their own chips. So why would any other customer do that? But Nvidia, which used to be a big competitor of Intel, invested in Intel. Yeah. So this is some of the stuff that, and then going back to what you just mentioned, why would you invest in Anthropic 2 years ago? It's the number 2 player. How do you think about it? Is it winner take all? Is it if Anthropic or OpenAI got to AGI, and they're going to have different reasons for using it, it doesn't have to be winner take all. And they're going to have different, they have different definitions of AGI.
Probably just from a marketing nature and probably in OpenAI's case, some of the legal side. But I think I don't think it's winner take all, but I do think the thing we've learned in technology historically has been these are largely oligopolistic and in some ways from a value capture duopolistic markets. And so the complexity with AGI or this concept of self-improving, self-learning AI is that it becomes a very fast breakaway dynamic. And so you have to think about, one, do you build the best intelligence, which I would argue Anthropic has done a very good job of recently saying, intelligence is interesting, but actually once you reach a certain level of minimum viable intelligence and scaffolding around these models, products are actually more important. And what's been most interesting is OpenAI for a long time, people believed was meaningfully out executing Anthropic on the product side. ChatGPT was the clear brand winner, the clear consumer winner. Not many people knew of Claude, and Claude Anthropic kind of consistently tried to think about how to work with the enterprise more. And I think what they've done agentically over the past 6 months has just been mind blowing. Mm-hmm. And our view is that there are still many products that these labs will not culturally own and won't be able to win. I think why coding has been so clearly, obviously, one that the frontier labs in our mind will own is because it's core culturally to the thousands of people that work at these companies.
So for instance, OpenAI, like you just mentioned, it was considered the clear, consumer winner. They were going to be the first ones to get to 1 billion monthly actives or however you want to do it. But Google and Alphabet, when they just reported, Gemini is, I think, at 750 million right now. And you think about their distribution, across, they have 7-8 properties that have over 1 billion. Half of them have over 2 billion monthly actives. Yeah. And if Gemini as a product is catching up to ChatGPT, and it's different use cases than Claude, right? We can kind of agree on that. What does that mean for OpenAI and valuation? Because let's just say you had OpenAI mark to market. I suspect it would be down 25% from its highs in valuation terms, but now they're looking to raise capital up 50% from their last raise. And those sorts of disconnect, just don't make sense to me as a markets person, so help me think about that, because again, Microsoft's down 30% from its recent all-time highs. Google on the flip side, the narrative has totally changed. GCP growth is fine relative to what Azure's deceleration, but Gemini as a model has really caught a lot of steam, and this is just in the last 6 months.
Yeah, I mean, I think maybe the big thing that we believe is we are in the lowest conviction time in investing history, maybe that I remember in my short life at least. And so what that means is this point of these narrative rotations happen so quickly. Mm-hmm. And I would argue it only takes a few meaningful shifts, even with the newest Codex model from OpenAI. People are now starting to be a little more bullish on OpenAI.
Yeah.
Or 4-ish months of everyone loving Claude Code, or maybe 3.5. Gemini has been weirdly silent. Nobody's using their code product. And so I do think that this is it's important to zoom out, and this is one of the ways why we have such a zoomed out lens here is these intermediate steps. And I think Google is probably the best example of that, which is if you were remotely thinking about Google's moats as a business, 16 months ago, it was a pretty easy layup to long that. And I think if you're looking at Microsoft today, that might be a similarly easy layup, maybe. Yeah. And so I think Google will continue to have the distribution. I think more importantly, they have a lot of the lindiness on the security side, which is what people more and more are worried about. And so Google is world-class at file data security, being able to work with large enterprises that care about that very meaningfully. And right now, eventually, I think that could be a big thing that turns, which is you have a lot of people now giving largely ChatGPT and Claude open file access to their computers, and you're now starting to see really bad security incidents, and eventually that's going to happen at scale, and someone's going to be you can't use these companies even if they have the right compliance. You just have random employees giving up file system access to their entire computer. Well,
and it leads me to something, and I haven't mentioned this in a long time, but maybe Google and their hoped full acquisition of Wiz, which is a security platform across multiple clouds, right? Maybe and you're using different models on different clouds and you have different data stored there. Maybe that's something that's really underappreciated if they can get that deal done.
Yeah.
And people forget this is a $32 billion deal.
Drop in the bucket.
And it's not an acqui-hire like we've seen, you know what I mean, that sort of thing. But they just raised their CapEx 50% to, you know what I mean? And they also have this other deal, but they're also raising capital in Europe 100-year bonds, sterling denominated. I mean, there's some weird stuff going on.
Yeah, I mean, I think we're at a period of unprecedented volatility across everything. And so I think like for the first time, maybe people would rather own Google paper than American paper.
Yeah.
And so like that's
crazy?
it's pretty interesting. And like if you were to think about what is more durable from a global lens, like it's not unreasonable to me to think that. It's like a little of a crazy statement, and I think Google is probably like, what are the ways in which we can make sure we win this? Like they have by far the largest capital advantage, Meta probably being the second, but Zuck loves to burn down his cash reserves pretty aggressively.
Yeah. And they're getting really creative on financing.
Yeah, apparently too creative, depending on the auditors. But
yeah, and part of it is, and this is the next leg of this with the ones that have the monopolies, the moats. They had the balance sheets. They certainly have the cash flow generation, but they're kind of getting to a point where that kind of debt to equity ratio is getting to a place, and the use of cash flow is not something like if we start seeing these companies pull back on their buybacks.
Yeah.
Which would be interesting. That would be natural, right?
Yeah.
But it will be interesting to see how market, perceives that. Oracle is going to have to cut their dividend.
Yeah.
They have negative free cash flow the first time in 30 years or whatever. They're going to be the first patsy. Like it's just, when OpenAI, if it were to pull back on some of these obligations, Oracle's dead.
Yeah.
And it's already been dead. And I think the markets have already spoken to that. Will you give me a sense of what do you think investors are underappreciating right now about Microsoft's positioning, both with Azure, both with their relationship with OpenAI, their relationship with Anthropic, which is, kind of interesting, their ability to monetize across, let's say, the hundreds of millions of 365 users and that sort of thing?
Yeah, I mean, I think on one hand you can take the stance of like, I think you were talking about this before of, there's only so much people are willing to spend on a seat-based license, right? I think over time we're going to start to see that seat-based licensing is like not how these things are going to price, and that's going to be pretty meaningful. I think if you look at Microsoft just as a company historically, one of the things they are best at is dumping free product onto the market in order to destroy competing software products. And the Teams suite is probably one of the best examples of that historically. And there are others to the point where people had antitrust cases against them. And so I think that dynamic of if you own a lot of distribution, if you own the kind of core node of data within an organization, that will allow you a position to have a right of first refusal across a lot of the enterprise. And that's probably something that everybody likes to look at Azure because it's the thing that you can kind of cleanly comp against the other Mag 7 type players on. But I think that is probably the more underestimated part of just like, what does the application layer look like? Yeah. Again, I don't have super strong views on the OpenAI versus Anthropic partnership. And obviously I think those things will be valuable. But I do think that if I'm looking at, why to sell off Microsoft, they seem to be one of the better run, more sensible players with a pretty large structural advantage in distribution and product, which I think is a thing that matters more. And if you even continue to do something that we think is quite interesting, which is if you can deploy models locally, you meaningfully change the margin profile of these businesses over time. So there's like a very
just explain that for a second.
Yeah, so there's a very meaningful chart that we think is like maybe one of the most underappreciated charts in all of AI, which is generally 12 to 18 months after a frontier model comes out, you can run it locally on like a high-end consumer GPU. And so what that means is that if you get to a model that can do a bunch of work, today you're paying a bunch of inference cost. You're effectively being metered by the cloud providers or the API providers. And typically the other thing you're seeing is open source models lag frontier models anywhere from 6 to 12 months. People will say it's shorter, but let's just say it's that.
Well, with Llama, it's longer.
Yeah,
right?
Longer. Yeah, with non-Chinese models that are trained off of the outputs of the frontier models. But and so I think that those two things get to a point where, today a large number of engineers would say, Claude code with Opus 4.5, but 4.6 is good enough for 95% of what I need to do. So if you imagine that in 12 to 18 months, you can run that quality model locally, you no longer have to pass through any cost to an API, and you own the product side, your margin can go from, let's say, like 50% to 90, right? And so there's a bunch of businesses that are going to become very, very interesting once you can run local inference. And you either can do one of two things. You can say, the larger models are going to be, they're going to continue to be compressed to get to run on these computers. The second thing you can do is application layer businesses are going to take the open source models, fine tune them for their specific use case, and say, for 95% of your use cases, we'll run it through the local model that we own, and for 5%, we'll route it to Opus 5 or whatever it is. And so Cursor is probably the earliest example of this. They have a model called Composer. It's a coding model. It's good. It's not amazing, but it's very fast. And the inference is cheaper. And they trained it. It was rumored to be fine-tuned off of a Chinese open source model. You can imagine there will be more and more of those use cases. And so if you're Microsoft and you have a research team that is pretty good at actually, one of the best things they do in research is very small models, you can imagine that margin profiles will be meaningfully different for these businesses for a long time.
And is that kind of the bull case as it relates to Apple? Because they want to be on device, and for them, it seems like the licensing deal they're doing with Gemini is like free for all intents and purposes. And I'm sure there's going to be some GCP aspect of that where they're getting it back. But Apple, at 2024. Their WWDC, they roll out, Apple Intelligence. It sucks. Siri still sucks. You know what I mean? And then they were in the penalty box for a while. Their whole thing is that they've been working on smaller models. They meant to integrate it into Apple Intelligence. Then there's this application aspect of it within their services, right, that they're going to be able to monetize. And they didn't have to spend hundreds of billions of dollars in the build out that like the hyperscalers. Now that actually hasn't come to fruition, and we're sitting here, it's mid-February, and people were really getting excited about when they're going to relaunch the OS and what's going to be embedded in there. And then I read the information the other day is that they're hitting snags again. So to me, that's a problem. Let's go back to this whole issue of arms race here among all the hyperscalers. I think the projections that there's going to be another $2 to $3 trillion spent between now and 2030. And then when you think about, these are basically closed models for the most part, right? But in China, they're all open models. And you're seeing them much cheaper to develop on. And they're going to be, all over, let's call it Europe and the developed world. And it's almost like a digital belt and road. Do you think our companies here are focused on the wrong thing? They're spending all this money while the Chinese, let's assume they're spending maybe half. We just don't know, right? As far as the GPU front, but maybe it's much less. Are we focused on the wrong thing? Because are our companies going to be limited in their ability to kind of have, basically, world domination the way we have in so many other things relative to what the Chinese are going to be able to do?
I would say no. And there's a few reasons why. I think one, where people look at Chinese performance is on a subset of evaluations that I think are becoming more and more well understood, easier to game, and also easier to less relevant. If you look at, there are some other charts which are there's a thing called strange evals, which is like these evaluations that are built around more realistic real world tasks. The Chinese models are like not inflecting remotely as much as the OpenAI and Claude models and Gemini as well. And so that shows you one thing, which is like this real world performance is actually not scaling it the way that people think. I think that your point that you've talked about before, which is like, are we focusing on the wrong thing by having like this intense competition? Everyone's burning down hundreds of billions of dollars to go against each other, is like, it's a China versus US collectivism versus capitalism type thing. And I just I would prefer at this moment in time, the government doesn't try to create a collectivist movement on AI. And so of any moment in time.
No, I agree. And they're not likely to do it anyway. No. This would be the one thing where all those CEOs jump off the bandwagon that they've been on as far as with the administration, because again, I mean, this is not how they've ever operated, and it's not how they would going forward. Okay, let's talk a little bit about how some of the ways that you are expressing views as a VC. And then I definitely want to hit what you think the opportunities with your public fund are. So you've invested in some amazing companies that we have talked about over the last few years. Give us a sense of kind of, those were not these shitty software models that a lot of vintages of the 2020, 21 VC, they can't get rid of some of those things that they've invested fast enough, right? So, but you've had some really durable thesis on this, and these companies, they're they're demonstrating from a monetization standpoint, right?
Yeah.
Like right now. So give us some examples right now, because I know there's some great companies that maybe are not Anthropic or OpenAI, but they're going to be ones that actually really define their field.
Yeah. So I guess the first one would probably be Runway, most notably because they announced a fundraise yesterday.
Mm-hmm.
We led their seed round back in 2017 or early 2018. They are building the frontier video generation model, but their broader view that they've learned over 8 years of research has been that as you learn to generate videos, these models can scale and generalize, and they can start to model the world a lot more. And so today they work with the vast number of people in entertainment, generating 9 figures of ARR, growing incredibly quickly. They are also now starting to work on the robotics side, because if you can generate a bunch of different environments, the core bottleneck in robotics today is data scale and kind of leveraging that in order to train better, robotic general policies. And so in that case, that just came from, again, looking at where research was, looking at the line and saying, okay, you need to extrapolate the line more. And I think maybe slightly different than people who backed, OpenAI around a similar time, we believed that AI was going to be a way in which you would break out, but not the durable thing. The durable thing in our mind is product and like the workflows within these things. And so over a long time horizon, I think that these video models and world models will commoditize in some rate, but owning the product workflow is incredibly valuable. And I think that kind of relates to some of the views on like software that people who are very bullish software still have today.
On the robotics front, really quickly, because again, and you and I have talked about Tesla in the past. I mean, the story is really now about robotaxi and robotics, and then really, he's built XAI. It seems like there's like a mass exodus of executives there, and usually that we've seen it with Apple or some of these other companies. And Gemini, we saw some of the stuff, going back a couple of years ago. Usually that means that maybe these things are not on the right track or at the pace in which, a guy like Elon was hoping for. What do you think of, actually, you have autonomous driving as something, and we're going to get to that in a second, but let's start with, Optimus and the strategy there. Do you think, again, of course he's going to do what he says he's going to do, but it's going to take longer.
Yeah.
Where are you on robotics and the idea that you're going to have a personal butler versus, robots working really well in warehouses and doing other activities?
Yeah.
I'm just curious, like how that shakes out a little bit for you.
Yeah. We made our first robotics investment in 2016. A lot of the ideas around that back then are the similar ideas that have come to fruition now. And a lot of it was using intelligence to have more generalizable robots. I think that is undoubtedly happening. It's undoubtedly happening because of the dividends from the LLMs. These things can model the world decently in language. And then a bunch of the things we've learned around these video models and these things called VLAs. Our view is that this humanoid vision of the future is not the correct one. Not in every market, mostly because of 2 things. One, scaling up manufacturing these is like very non-trivial. The cost curves that people model, I think, are unrealistic relative to the quality of the robots needed. So yes, you might be able to build a $10,000 humanoid in 5 years. Will it break every 2 to 3 months of usage? Maybe, and like that meaningfully impacts the LTV of these things and the economics. And so then I think you have to say, okay, if these are super high performant on the humanoid side, what are the most high performing areas? And I think we talked about this last time, but it's modeling not the cost of labor, but the cost of losing the labor. And so you look at military, you look at industrial. The life in an industrial worker is actually orders of magnitude more than their hourly rate. And like that makes a lot of sense to deploy something very, very expensive. I think the second thing is similar to what we're talking about in software is distribution matters, and distribution in software is super easy to rip out. You have data moats for sure, but you can replace it. In hardware, it's a lot harder, right? You're like replacing the robot in your retail space that's, in all of your systems, has your inventory set up, the customers are used to interacting with. You're not just going to make a quick decision because some SDR called you that day and offered you a better price. And so we believe that the time lag between any sort of humanoid kind of distribution at scale will be eroded by vertical specific robots that do specific tasks that are very, very high value and have like meaningfully good margin in the near to midterm. And I think that ignores the other point, which people can debate or not, which is, the main thing everyone says is, well, the world is built for humans, so obviously we should just build more humans. I think that's like an insane framing to think about.
Well, look at the demographic scenario around the world. We're not going to be building more humans. That's done.
Yeah. And so I think like in general,
Elon's trying to.
Elon's trying.
He's trying to do both. He's still going down parallel paths, I guess.
But I just think like the humanoid modality just doesn't make sense in a lot of these spaces. So we're more bullish on the vertical side.
Yeah.
Some of the labs are great.
It's funny though, he sucks the air out of the room because he's talking about the thing that's sci-fi and sexy. You know what I mean?
It's very easy to grasp.
Yeah. But interesting insights. All right, let's talk autonomy because this is a company that I think is not on people's radar, but I keep seeing, really interesting, I guess news pegs around it. So talk to us a little bit about Wave and how that fits into your whole thesis.
Yeah. So we've been partnering with Wave since 2017. Very different technical approach to getting a car to drive itself. Very similar to what we learned in transformers and LLMs later on, single model instead of multiple. The main view is you and I could go into any city and we have 2 cameras and we have a underpowered but highly efficient compute in our brain and we can learn to drive whether we've been there or not. We kind of know the principles. That is not how most self-driving cars have been built historically. It's built very differently. Wave took that approach, one model, hyper-scalably with cameras only, and has publicly announced one OEM deal with Nissan and is working on a bunch of other things. And we believe that Wave is the clearest path to 100+ cities of autonomy very, very, very quickly, to the point that we sent cars throughout the United States and the world over the past year and a half with 0 training data. And I was one of the first rides in New York City and drove around flawlessly for 55 minutes throughout Lower East Side, Chinatown, Brooklyn, over the Brooklyn Bridge, all over. And it worked great. And so
had they been training in New York City?
0 data.
Really?
0 training data in New York.
Isn't that interesting? Because it seems like whether it was Waymo or what Elon's been doing, one of the things they lead with is how many hours, and we're talking about hundreds of thousands of hours, right? So what is it about Wave and their technology that's so differentiated from these two? Well, Waymo is obviously the early, and I've been in Waymos. They're freaking amazing. You know what I mean? And I'm sure it's the same experience that you just had. So talk to me a little bit about that.
A simplistic idea is that you can learn the principles of driving with significantly less data if you have a certain type of architecture and if you architect your entire data pipeline and learning system in a way. And then if you have a bunch of simulation synthetic data as well. And Wave has built kind of that full stack. And they've done it with the ability to move it to many different types of cars, which is a secondary thing that people don't appreciate, which is, if you've noticed, Waymo is starting to move into different types of cars, but where the sensors sit for a sensor stack that big actually meaningfully changes a lot of their ability to do autonomy. Tesla obviously is a single, 3-4 sets of cars. And so we still believe that data matters quite a bit. We still believe that there are data moats in autonomy, but we believe you can do it far, far more efficiently. And, funny enough, our largest investment ever out of Compound from a, initial investment is in a new robotics lab that has a very different but similar approach of data scale that is underappreciated technically, that hopefully we'll be talking like this in 7 years about them. But I think, the data scarcity problem is probably one of the most valuable ones to crack.
All right. Uber basically has run away with ride share, hail, whatever you want to call it. How do you see, first of all, anything on Uber's strategy as they're thinking about it? I know they've partnered a bit with Waymo. I've been to Austin, and when I pull up, but you have to go to the Uber app in Austin, to get a Waymo. And I've been there a couple of times in the last few months, and all I want to do when I pull the Uber app is get a Waymo. And it doesn't work that way. You know? So I'm just curious, how are you thinking about, is it going to be winner take most in a market like the US? And is, Uber going to have a strategy that you think, because of, again, their network that they have, and, that it should be one of the things, I think for Robotaxi at Tesla, it might take a while for people, it's going to be, little by little, I'm just curious, how is Uber positioned, and will it be a winner take most?
So Uber has announced a partnership with Wave in London. And I think Uber has a view that on a long-term time horizon, their network will possibly have lots of different autonomy providers, or they will have certain regional
So asset
autonomy.
light for them is
I think so. I think Dara has a lot of different views around how one can run a network asset light. And I wouldn't bet against him as an operator. And so I think in general, like if you can go asset light, or if you can go maybe we'll call like asset medium, you clearly need to figure out a playbook versus Waymo, because as we've seen in San Francisco, Waymo has meaningfully taken market share against Uber, and people have very, very high affinity for the brand. And I think that brand is only growing nationally in the US. And so I would say Uber recognizes that, and they are aggressively trying to figure out what the right path is, including they've recently spun up their own autonomy team once again, which they killed, I think, 5 or 6 years ago. And I guess we'll see.
Yeah. So, and again, Uber's a company that is clearly, it's other sort of themes that are weighing on it. And this is the main one. It's not really, it is AI adjacent, but, okay. And then last one, because this is one, so this is Orbital, and this is probably one that I have the hardest time getting my arms around because I'm not that smart. So talk to me a little bit about this company and why it's so disruptive.
Yeah, Orbital is founded by Jonathan Godwin. Johnny led the team on the chemistry side at DeepMind for many years, left and started Orbital back in 2021. We backed him at the seed round. And his main view was that foundation models for chemistry would require slightly different framing than traditional language models. Most importantly, he believed that you needed to build a lab to close the gap between like what people in traditional AI call sim to real, which is do a bunch of things computationally, synthesize material, then feed all that data back in the model. When we invested in the company, other VCs hated that because it's like CapEx heavy and it's this weird non-computational approach. What they've learned is that the materials they've been able to synthesize are like meaningfully valuable and powerful, and they centered on a few products. The biggest product today is what's called a two-phase chiller, and effectively it's a modular data center that is, as of today, the only solution in the world that can cool the next generation of NVIDIA chips. And so as you can imagine, as NVIDIA continues to create more and more powerful chips, everybody knows electricity is a big problem, power is a big problem. And NVIDIA has this kind of nice positioning saying like, that's not our problem, you guys figure it out, we sell you the chips. And there's a bunch of players around this that have benefited from this, like in public markets, Vertiv is an example of that, Eaton's an example of that. There's all the neoclouds as well in some ways. And Orbital basically is the solution to keep these things cool with traditional cooling, which has been fan, and then a newer generation of cooling, which is liquid. You run liquid over these compute stacks. And so we think that business will similarly scale towards 9 figures of revenue very, very quickly.
Who are their biggest customers?
They haven't disclosed any of their customers, but they work with a lot of the large cloud providers and people building data centers.
All right. What do you think about, as it comes to cooling, what do you think about cooling in space? What do you think about data centers in space? Just call it fucking stupid. Just do that. Just please do that.
Listen, I have friends who are investors in those companies. And I hope that they work. I think that I loved Sam's total denial of them on, I think he was on TBPN or something recently and was just like, never going to happen. It's a good story. It's an amazing story.
Narratives. You need that. You need people to keep
markets.
Interesting. All right. Let's talk, and we can kind of finish here. So you launched a public markets fund. You obviously are very in tune with the public markets. That's how you started. Obviously, like we just talked about before, vol trading is a little different than, 99% of the way people participate in the public markets. But why now? The timing could actually be amazing, especially like a lot of the names that we just talked about. Why is this on the radar of Compound VC? And are you guys going to have to call it something else?
So we intentionally never call it Compound VC.
Okay.
We always call it Compound. We call ourselves a research-centric, thesis-driven investment firm. I think the main thing that we believe is this approach to investing, which is doing very deep research and then future projecting these second and third order effects. The way we've liked to make money on it historically has been very, very early stage. And we still believe that is incredible thing that we're quite good at. We have always been very active participants in public markets and liquid markets broadly. We do both liquid crypto investing as well as public markets out of this vehicle. We think that the ideas that we have seen are coming into markets far faster than ever before. We think that we have a very unique lens towards what those could look like. And we think that being able to have a captive pool of capital that is not liquid for our investors, is closed end, allows us to express those views in the ways that we think best. We're not hyperactive traders. We are we build a thesis, we do a lot of work. We understand where we think prices could go, and we take a position, and we do it in a relatively concentrated way. And so,
will you share those names? Not right now. Maybe if you come back.
Yeah.
Okay.
Yeah.
All right. Well, just as a little teaser.
Yeah.
Michael's going to be coming back.
Yeah.
And we're going to have a lot of great. But listen, I think a lot of what we just did over the last 45 minutes, I think is really helpful. One of the reasons why I love having people like you on is that a lot of our listeners, a lot of our viewers are here for the public market stuff, but not understanding what's coming for them in the private markets, I think is really interesting. And then a lot of these companies, are hoping to go public over the next couple of years.
Yeah. Yeah. And I think in general, you can see these moves of volatility that are fundamentally oriented versus not. And then theoretically, that should allow you in both directions to take meaningful stances. And so we think a lot about it from both the long and short side. And so we do both. And I think it's as exciting a time as ever to be investing. And maybe the last thing I'd say is in technology investing today, we do somewhat controversially believe the only performance-oriented asset classes anymore are early stage venture and public markets, and everything else has become fee-gathering asset classes, growth funds that are $12 billion, whatever it is. And so we like to perform in small performance-oriented ways, and that's really what drives us. We're obsessive about like the craft of investing. And so this is something that we think will help our seed stage investing, and we think our seed stage investing will meaningfully help everything else we do on the liquid side.
All right. Well, I always have to thank Danny Moses and David Hirsch, your partner, because you and I could do this like Joe Rogan style if you were willing to do that. But right now, you got more important things going on. So, Michael, I really appreciate you being here. But you're not leaving. We're going to have this great conversation on crypto. As I mentioned, I'm bringing in a friend of mine, Evan Karvounis, a young guy who's got, I think, a unique approach to looking at the space. And in a very short period of time over the last 5 years, I think he's become somebody really smart on this sort of stuff. But this is something that you've been focused on, too, over quite some time. So we're going to have a quick conversation about that. So stick around after the break, Evan and Michael. And I'm just going to be the dumb guy, kind of directing traffic a little bit. So stick around. All right, welcome back to the Risk Reversal Podcast. I'm Dan Nathan. Michael Dempsey from Compound is still here. As I teased before, we have Evan Karvounis. I would say he's an old friend, but he's a young man. But I've known you since you were a little guy. You graduated from college a year ago, USF. And you and I have been talking about your endeavors in crypto for, I think, about 5 years. So, Evan, welcome to the podcast.
Appreciate it. Yeah, thanks for having me.
First ever podcast, Michael. You're like a pro. This guy can do it blindfolded.
Yeah, I got to make sure I'm like,
don't blush. You are on video. Okay.
Awesome.
All right. Really quickly, I think a lot of the listeners or viewers who are just sticking around for that prior conversation, they have a good sense for Michael's background, but we didn't talk crypto. Yeah. Really quickly, tell me how you view it and maybe a little bit of your history there and how you're expressing views.
For sure. I got into crypto in 2016, mostly because it was a bunch of people who were really weird and really smart doing like crazy sounding things to me. That always is a sign that I should probably understand it a little bit. We started making a variety of venture investments out of the fund, as well as some fund investments. A large portion of what we did from 2016 to 2019 was on the infrastructure side. And then I think come 2021, as the industry kind of had a blow off top and reset, the thing that we believed was we didn't need too much more infrastructure, and we started to move much more towards application layer investing. And we do that at the seed stage, and then we also do that on the liquid side. And I think to sum up very simplistically how we think about that world today, we think the vast majority of crypto protocols are very overvalued. We think a subset are undervalued, very small subset, and we want to own those on the liquid side in relatively high concentration. And then we will probably short a basket of them on the other side.
All right. This is like an amazing meeting of the minds, because you and I had a couple drinks last week. It's one of the reasons why you're sitting in the seats. And I think you have a very similar view as Michael. So we're going to tease that out a little bit. But Evan, really quickly, give us your background.
Yep.
I don't need to know where you went to middle school or anything like that, but how you got in the space, because it was pretty unique. Was it late high school you got involved, or was it once you got to college?
Yeah, so I first heard about crypto around the same time as you, 2016, 2017. I was super young at the time. I was working a dishwashing job, and I remember hearing the cooks in the kitchen talking about Ethereum and XRP and all these ICOs and everything. And so I took like a little bit of a look. I want to say 13 or 14 at the time. Didn't really understand what was going on, so kind of didn't pay too much attention. But when I got to college my freshman year, I had a friend that was telling me about how he was making all this money trading NFTs. And I didn't really understand what was going on with the NFTs at the time. But what I noticed that I thought was interesting is you could see the highest bid and the lowest offer for each collection. And typically there was maybe like a 30 to 40% spread between that. People were crossing, 20, 30, 40, 50 times an hour. So that was kind of like my first introduction to it. Is I kind of got very drawn to the inefficiencies in the market, because previously I had tried to trade stocks. I opened a brokerage account with my dad when I was 16. And found that super difficult, and it was just generally a super difficult market. So I found crypto really interesting because pretty much anybody can participate no matter how old you are or where you come from or any of that. But it's also just, the most liquid, inefficient market on the planet. So that's what really got me excited about it.
All right, just a quick aside. So I know Evan, his dad is a really good friend of mine. He was a Navy fighter pilot, and then he went after being active, I think, through most of the aughts. He was a Top Gun instructor, and then he came to trade derivatives, not the same way you got into the derivative market or me, but he joined straight from the Navy at Merrill Lynch, and he was a very skilled trader, and he worked on the buy side for a little bit, but then he missed flying. Is that fair?
Yeah,
and he went back to fly Navy reserves, and then for FedEx, and he still does, but he keeps a track on the market, and he's very focused on one stock, FDX. All right, so let's talk a little bit about what you've been doing since then. So that was your entree into the markets.
Yep.
It was ICOs in 17, and then it was NFTs and a bunch of stuff, right? In 20 and 21, you were obviously involved in that. So how did things evolve for you?
Yeah, absolutely. So again, like what really got me involved was kind of the inefficiencies in the market. I found it to be like quite interesting, just like how similar these markets were to traditional markets, but also how different. And so, the strategy that I was running at the time was pretty much just click trading, market making these NFTs, because, you could capture 20, 30% spread pretty often. After the NFT thing, like that strategy sort of started to lose money eventually, like around December 2021, January 2022. And so from there, I'd met some people through Discord, which is like a online kind of chat room thing. And they were telling me all about DeFi and all these other aspects of crypto that I found super interesting. I was pretty late, like a little bit late to DeFi. This was after like Olympus and kind of after like Uniswap and Aave had really come out.
Which were decentralized trading platforms.
Exactly, yeah. So Uniswap
that
is
had their own
essentially
tokens, and it was Okay.
Exactly. So Uniswap is a place where you can trade pretty much any on-chain asset. Aave is a money market to where you can borrow against a variety of on-chain assets. You can borrow stable coins against Bitcoin or Ethereum or anything like that. But kind of like right into the DeFi thing, found it also like very interesting. And then pretty much spent all of 2022 and 2023 just like learning and kind of going down the rabbit hole of all these protocols. And kind of understanding them at like a very fundamental level. Did a lot of trading on the ETH on-chain side of things in 2023. Traded a lot of Solana on-chain in 2023 as well, which got me kind of familiar with the differences between Ethereum and Solana kind of at the protocol level. And found there to be some really interesting kind of correlations between like chain activity and kind of like the token value, which we'll kind of get into in a little bit. But like I personally think that Ethereum and Solana are both like grossly overvalued, generally speaking. I think that they have like 95% like lower to go.
Whoa.
Yeah.
It's a big number.
Whoa.
I mean, I think like it begs the question as to like why.
Wait, so the president said that certain prices of things are going down, 500, 600, 1,000%. Does that work or no? Like, I'm just curious. Like, does Ethereum have the ability to go down 500%?
I mean, it is like a commodity, as they say. So
Okay. All right, I'm just curious because you guys are the smart math guys. Whatever. Okay, sorry. Yeah. So all right, you and I are going to talk about that after our conversation with Michael. But where are you right now? I know you interned at Galaxy this summer between your junior and senior year. And how have you spent the last couple years involved in the crypto space?
Yeah, absolutely. So I interned at Galaxy. So I graduated from college a year ago from USF in Tampa. I interned at Galaxy summer after my junior year, so in 2024. Spent time with their sales and trading teams, which was great. It kind of got me exposed to how an institution like Galaxy thinks about markets, how they manage risk, how they interact with DeFi, which was very interesting to kind of learn and be surrounded by other really smart people. And pretty much, yeah, ever since then, I've just been, doing a lot of trading. I found Hyperliquid, which is something we'll talk about later, around late 2023. and kind of like spent a lot of time. That was pretty much what I was mostly focused on in 2024. And even to this day, I think it's the most interesting story in crypto today.
All right, explain it, because you and I were talking last week. It was like, for me, a really interesting last couple of weeks. I was with a really smart friend of mine who's a CEO, founder of a company called Masterworks, and he had mentioned to me that he's really hot into perpetual preferreds and and Hyperliquid, and it happened to be, I was like, I don't know anything about it, but then a guy across the table, we were out, knew a lot about it, and the two of them just freaking nerded out to the point where I had to like switch seats to go over with some people who were just talking about other stuff. Okay,
part about crypto
and then he and I, you're right, and then he and I were out for drinks. I want to say days later, and I asked him like, "What do you think about what's going on?" And Bitcoin had just hit 60, and Ethereum just hit 1800 or something like that, so cut in half, both of them. And he said, well, yeah, I think those are massively overvalued, but I'm really into Hyperliquid and hype, and I think that's most undervalued. So I think this is where I'm not going to get in the definition of perpetual preferreds because I think it's really complicated. But talk to me a little bit how you came on to Hyperliquid and why you think that is very undervalued in the platform in which it trades, and I'd love to get Michael's take on that too.
Yeah, absolutely. So I guess I'll just start by kind of defining, I'm not going to define what a perpetual swap is, but perpetual swaps make up about 80% of all the volume traded in crypto today, which is obviously a large number. It's about, I want to say like a $20 billion annual fee opportunity. Like there's $20 billion of fees that passes through companies like Binance and Bybit and obviously Hyperliquid. Today, Hyperliquid accounts for about 7% of the total market share of perpetual swaps. That's up from 2 or 3% about a year ago, and much smaller than that in 2023 when I first found it. And so essentially the story is that it's a decentralized exchange, which means that at all times you have full custody of your assets. Like there's not going to be an FTX situation where, oh, sorry, our in-house trading house is gambling with your money. You always have custody of your assets. It's all on chain. And what's interesting is they have a native token called Hype, which 97% of protocol revenue programmatically every minute, every hour goes and buys back the Hype token. So it's essentially like the first, in my opinion, the first real instance of a economic interest in a protocol that really acts like equity. And so that's why I'm like super interested in it, is because it's kind of the first time when you get to have an economic interest in some of the most efficient businesses on the planet, right? Hyperliquid has 11 employees and they make about $1 billion in net income. So I guess that's like the short story.
All right. So, to me, a lot of crypto, and I've been following it not nearly as closely as you guys have since 2017. And, the narratives is really what has driven a lot of the interest by the normies, I guess, right? And then there's hardcore people like you guys who you invest from a VC standpoint, but you also look at the underlying protocols, and you're looking what tokens are working and why, and the usefulness of them and how they accrue value, right? Yeah. So where are you, Michael, right now? You seem to know a lot about Hyperliquid also, and you think it's undervalued. And I'm just curious, do you think relative to, like, let's say Bitcoin and Ethereum and Solana, that they're way overvalued?
Yeah. Well, I'd remove Bitcoin from all of this. Okay. I think Bitcoin is a special snowflake that I buy every day, and there's a bunch of reasons why.
Okay. I want to hear those reasons.
I think that Hyperliquid, the most interesting part is it started as an application. It then moved from application into a layer 1 blockchain, which is direct competition to Solana and Ethereum. The probably other point of why we are most bullish on it, which is actually more structural and less financial. I think the financial multiples you can get into of perp volume, and they're eventually going to they have launched tokenized equities, and there's a bunch of other things that will drive very, very large earnings growth. Is from a team perspective, Jeff, who's the CEO and founder of Hyperliquid, is formerly high frequency trader. He's incredibly good at understanding how do you build a singular product and then expand. If you look at the history of crypto, the vast majority of protocols have built single act companies. And if you look at the history of technology, the thing that we learned in Mag 7 most notably is that multi-act businesses is what allow you to create $500 billion to $2 trillion to $4 trillion outcomes. Crypto has never done that because typically teams launch a token, they start to sell down the token, and it's open source, and they move on. There's a few existing teams that have done that, but Uniswap is generally one of the more innovative things that has existed in crypto, still pretty similar today. Aave is a DeFi protocol on the lending money market side, and the product has not changed much at all over the past 4 to 5 years. Hyperliquid is a very different view, which is they have basically looked at each of these financial markets, and they went with perps first. They then moved into pure spot buying. They then moved into on-chain equities as well as on-chain other on-chain real-world assets like commodities. And now they're moving into prediction markets. And they just very clearly understand that if you want to build something that is durable in a fast-paced market, you need to have many, many acts and compound those acts over time into a single asset that everyone can own. And so that is why we are bullish on Hyperliquid, because just by nature of, yes, they have a bunch of room to go on the perp side of taking out Binance and taking out Bybit, and that will generate, $5, $6, $7, $8 billion in net income a year. They also can then go take out Robinhood and a bunch of others. And so if you look at them and comp them to a Robinhood, they are like meaningfully undervalued.
Wow. And you think that is a legitimate risk to a platform like Robinhood?
I think that if you look at how assets like Robinhood and more clearly Coinbase have traded, you would be able to see.
They're more than cut in half.
Yeah.
I mean, Coinbase is down 60% from its recent highs, and that was when Bitcoin was 125,000.
Yeah.
And Robinhood just reported this number where a friend of mine, Jim Chanos, had this data. He was digging into the numbers. He basically said since the end of the NFT craze, it was like kind of mid 2021. For the most part,
everyone's lost money.
Yeah, did you see that? I mean, it's pretty fascinating, right? And it topped out when Bitcoin was at 125 and 0 days to expiration options, like, all that sort of stuff. Interesting stuff. So you think Hyperliquid is way undervalued relative to some of these like platforms that we know and love and probably all use. Now, is the only way to express, did you invest as a VC? Did they raise VC capital? Or the only way you can get involved in this is buying hype?
Yeah, the only way they've never raised any venture money.
And all right, so really quickly, because I know you got to go, why do you buy a little bit of Bitcoin every day? And when did you start doing that?
Started doing that probably in 2018.
Okay, so that's worked out okay.
Yeah, 2018, 2019 probably. I think it's an asset that is going to endure for a long period of time. I think that historically the holder of the asset has been a person that also trades risk assets and technology pretty aggressively, and that's why you've seen a lot of correlation with tech. And I think that over time, the holder base is going to move more from a pure risk asset trader to people who view it as a store of value. And so if today...
Why hasn't it worked as a store of value? Gold went from 1,500, I want to say 5 years ago, to 5,500. Now it's come into 5,000. I mean, the only use case for gold, other than, you know what I mean, like, is store of value.
Because if you believe that, let's say 7 years ago, before government started buying Bitcoin, 1% to 5% of holders viewed as a store of value. I would argue today maybe 10 to 15% do. And over time, those asset holders are going to continue to grow. And that is also why you've seen lowered volatility of the asset over time. Bitcoin is the least as of 2 months ago, was least volatile it ever been. And even the current drawdown, if you think it doesn't go below 50K, will be a less worse drawdown than the prior cycles, all of which have had less worse drawdowns each time. And so I think that suggests that people are viewing it slightly less as a levered risk asset. And what's interesting about gold is also as gold moved on chain into crypto and the types of people who started to buy gold, where people are trading tech equities, you've seen some of the largest intraday swings in the history of gold. And then you saw that move into silver and palladium and other things. And so that would actually suggest that gold is actually taking the opposite direction, which is it's turning into a bit of a speculative asset.
Yeah.
And so I think those two things are quite interesting. And I also just think maybe from like a longer term, crazier thing, I think the vast majority of countries do not want to control their monetary policy long term. And they're starting to realize why that's a nightmare for them. And about 1 billion people today have had massive amount of currency devaluation. And I would say the wealthiest countries in the world are losing trust in their institutions even more than ever. And so that billion could turn into 4 billion over the next 10 years. And Bitcoin is possibly one of the best assets to own in that world.
All right, we're going to get Evan's take when we come back. Michael Dempsey, I really appreciate all the heavy lifting you did on this podcast. You made me smarter. I hope you'll come back really soon. So thanks, Michael.
Definitely.
Stick around. We're going to get Evan's take on all that. Thanks.
Thank you.
All right, welcome back. I am still with Evan. Appreciate Michael Dempsey. He's the man. One of the smartest guys I know in the business, by the way.
sure.
And so maybe you are one of these like up and coming smart guys in the business. I'm not really sure.
One can hope.
So we're going to do Hyperliquid, and I'm going to want you to make the best pitch to me why I have to go and buy Hype. This is not investment advice, people, but this is you to me.
Yep.
But let's first focus on something. I mean, Michael, the way he was talking about Bitcoin. I want to get your take on that. But then you said something that you think Ethereum and Solana are 95% overvalued. So I want to hit that too. All right, let's start with Bitcoin. I'm sure when you were looking at crypto back in whatever year you said, it was back in 16, 17?
Like 2017, yeah.
It was like really the only game in town. You know what I mean? And then there was Bitcoin Cash and there was like all this crap and no one understood any of it.
Yeah.
So what do you think when you hear somebody like Michael, who's really fucking smart, say, I buy a little Bitcoin every day, and he just gave the reasons why he thinks that there's going to be a flip where a lot of people do view it as a store of value for a whole host of the reasons, central banks, gone amok and this and that or whatever. Are you in that camp? And you can disagree with Michael, and we'll have the two of you guys back together. He just had to dip, as the kids say. So give me your 411 on Bitcoin.
Yeah, so I think Bitcoin's interesting because I think that Bitcoin made a little bit here. I'll start with this. I'll say Bitcoin, the thesis of it's like the ultimate money. It's the next iteration of what money looks like. I think makes a lot of sense.
Is it though? Because people don't use it to transact right now.
Right.
It's not considered money.
Right. But I think if you think, and obviously this is kind of getting very futuristic, but if you look at something like gold and you'd imagine that at the pace of technology, I'm sure that there's a world in 100, 150 years where gold is it's as common as sand on the beach, right? Like there's asteroids in the asteroid belt that have gold, right? And I would assume, like, don't bet against technology. At some point, gold's going to be very common. And so I think,
but as a store of value, not deemed as something that you can use to transact with.
Right. I mean, I think Bitcoin, for a while, I mean, it spawned after the great financial crisis. It's kind of like the ultimate, I don't trust the institution, I want something. It's one of those things where it's the more people that believe in it, the more valuable it becomes, the more real it becomes, that kind of thing. I've never been like a Bitcoin maxi per se, just because it's sort of hard for me to, and maybe I'm not one of those smart guys, right? Like I could be like a total middle of the curve
debatable
guy.
Yeah.
But it's been hard for me to really understand the vision. And I think it's become especially hard after the past 2 years because Bitcoin made, unfortunately, a little bit of a deal with the devil with the Trump administration. I think at this point, it's kind of become...
And that deal is what, just really quickly, the reliance on some guardrails as it relates to regulation or deregulation, that sort of thing?
I think it's just, at this point, the Bitcoin brand has become synonymous with the Trump brand in a lot of circles, in a lot of ways. Like when you think Bitcoin, you think Trump in most cases. And I think that that's really damaged the idea of Bitcoin. And I think it's one of the reasons that gold is like really outperformed, because I think that the buyers of gold are very different than the buyers of Bitcoin, right? Like I was talking to one of my crypto trader friends, and he had an interesting take where he is saying that the West has kind of come around to this idea of debasement like 2 years ago or 2.5 years ago. And the East, which are typically the buyers of gold, are just now coming around to this idea of debasement. And like you hear about the lines for gold in China and stuff like that. And so I think that there's a real case where the Chinese look at gold and they look at Bitcoin and they look at Bitcoin and they think, oh, this is an American thing. I'd rather just buy gold because it's neutral. It's
well,
neutral.
What's interesting? All right, so let me ask you this. So I keep hearing about how much gold is, like in existence above the earth. Okay. And your point about asteroids, okay, well, whatever. Someday there'll be like, an asteroid drop.
Sure.
It's not going to destroy the world, and there's going to be lots of gold in it. And there's going to be like, a lot of people who make trillions and trillions of dollars. But my question is that if gold is a finite amount of it above ground, and I heard that like it could fit on like 2 feet high on a football field, all the gold that's come out of the ground ever. And so it will become digital gold if we don't mine a whole heck of a lot more, right? It'll just be the spread between the value that we have physically and then the demand for it, right? Isn't that the sort of thing?
I think that that's like a valid argument. I think the problem is that it's never going to be like maximally durable. And what I mean by that is that you have to hold your physical gold in a vault somewhere.
Yeah.
And there's always going to be some level of risk. Like, which country are you going to choose to store your gold? Like at that point, you're making a bet on how stable that specific country is going to be.
Right. But just like if you're buying gold right now, you're actually not buying physical. If you're bought like the GLD ETF,
sure,
right? You're just buying something that represents like the value of gold, its scarcity, right? Isn't that part of it or no?
That is like
a big part of it.
Of course, if you're buying the ETF, it's, there's a difference between buying physical bars and just like buying the ETF. Or
Yeah, but
something
no
like
one
that.
owns physical bar. I mean, the people who own, there's central banks that own the physical bars.
I mean, if you talk to like the real gold maxis, like there are gold maxis out there that they want to have physical gold because they're the type that are really concerned and stuff like that.
Yeah.
And so I guess that's the real case for Bitcoin, which is like a little bit of a crisis case, but it's like in a world where really, you can't trust institutions at all, and you don't want to make a bet on whether this country is going to be stable, or you don't want to buy the ETF because who knows?
Yeah.
I think
because it's on the traditional rails and
Right.
all that sort of bullshit. No, I totally get that. I also have this view that when we hit super intelligence and quantum this and whatever, the Bitcoin's gone. I'm just telling you, like if you have like the super intelligent machines, they're going to come straight for the Bitcoin and they're going to be using quantum, computing, and it's fucking gone. How's that? All right, so Bitcoin. Just to sum up Bitcoin really quickly, I get all those things. Are you like what % of your crypto allocation would you have to Bitcoin right now?
I don't own any Bitcoin.
Okay. Will you ever? What would be the reason why you'd buy it?
I think that I think that it made a lot of sense to own in 2022. Like I think that was the risk to reward there was very obvious because you had like FTX blew up and
That was the bottom.
right. And there was like a very clear next wave of demand. There was no ETF at that point. Sailor had kind of just started going with MicroStrategy. And so there was like a very clear like next order of magnitude of demand through the ETF. That was kind of right when around the ETF was starting to be talked about and everything. And so I think it made a lot of sense to own it there. I owned it in 2022. I think here it's a little bit harder to make the case because it's not as clear as to where is like the next like swath of capital that's going to push this thing higher.
Yeah, you already had retail got in the ETFs, and then there was obviously some institutional, like they could buy it that way, right? And then you had the treasury company demand,
right?
And then you had the regulation, the excitement around, the Trump administration, that sort of thing.
Yep.
As stable coins have anything to do, like the affecting of Bitcoin price or
I don't
interest?
think so. I think stablecoins are like a very separate. I think it's an example of the companies that build their businesses around the technology, like stablecoins, like decentralized exchanges. I think those are the types of businesses that make money off of the technology. I don't think Bitcoin is like a very separate thing.
All right, so you mentioned before that you think Solana and Ethereum are way overvalued. You even said 95% overvalued.
Yeah.
What are the use cases right now? I get it. Smart contracts, DeFi is supposed to be built on all that sort of stuff. NFTs have died. That was obviously a big boon for Solana, right?
Ethereum and Solana.
Yeah. So why are they so overvalued?
Yeah. So I think that if we go back to the very early days of Ethereum, for example, Ethereum came out in like 2014. That was when the white paper got published. It started to get big in 2016, 2017. It's where a lot of ICOs were hosted, that sort of thing. It was also the kind of the early days of DeFi happened around like 2017, 2018. That's where Aave started, originally called ETHLend back then. And so, Ethereum did quite well in the 2017 cycle. It did quite well in the 2021 cycle. It's not done very well this cycle. It's underperformed Bitcoin by a lot. And it begs a question like, okay, well, what changed? Why? What changed in this cycle? And I think the reason that something like Ethereum really outperformed in 2017 and 2021 is what I like to call the casino chip thesis, meaning
Did you make this up?
I mean, it's like it's an idea that's been like percolating in like crypto circles.
I believe you.
I just like call it the casino chip thesis because it kind of has like a nice ring to it. But kind of what I mean by that is that on Ethereum in 2017, you had a unique game that people were playing, which was ICOs, right? In a lot of cases, you either needed to buy Bitcoin to participate in these ICOs because they were traded against Bitcoin, or you had to buy Ethereum and they were traded against Ethereum. Similar case in 2021, if you wanted to participate in DeFi, what they call DeFi Summer, or if you wanted to participate in NFTs, you had to buy Ethereum.
Wasn't it Solana Summer? Packy McCormick wrote a great piece popularizing it. I really do believe on It's Not Boring, and he called it Solana Summer. Go check it out, people.
Interesting, yeah.
Yeah, do you know Packy?
I don't actually.
You should check him out. He's like a brilliant guy. I love him. He used to be on the pod a lot. Yeah, go ahead. Sorry.
No, it's all good. It's all good.
So what'd you call it? What summer? DeFi
Summer.
Okay.
Yeah. So DeFi Summer was like summer of like it was like end of 2020, early 2021, basically. Everyone was super excited about DeFi. And again, I think the reason that Ethereum did well is because you had to buy Ethereum to participate in DeFi, and you had to buy Ethereum to participate in NFTs because they were traded against ETH, right? ETH was like the money. Yep. ETH was the casino chip. Similar thing this cycle with Solana, right? The big thing this cycle was meme coins. To participate in the meme coin casino, you had to own Sol, and you had to, because all of these meme coins were paired against Sol, you had to first buy Solana, and then you would, have your casino chips to play the game. And so I think that's where the majority of the demand for Ethereum and Solana came from, is this like huge influx of retail that want to play these new games. And so, whenever those games get old and there's not this demand for the casino chips, you see underperformance. That's why Ethereum underperformed this cycle. I think Solana is going to underperform next, like from here on out. And I think that if you think about what they're worth, right? Ethereum's worth like 240 billion, Solana's worth 50 billion or so. And you think about the kind of fees / like revenue or value that they're creating, there's a great question that people like to ask each other in crypto. It's like, would you rather own Anthropic or Ethereum? Right. It's obviously Anthropic in most cases. And so I think that there's a lot of latent capital that got very wealthy and just kind of held these things up. And it's become a sort of cult like Bitcoin, where they are like true believers in Ethereum. And they're like, I'm never selling my ETH. I believe in Vitalik. I believe in the vision. And so you kind of get these cults which is why price takes a while to
all right. So Tom Lee, friend of the pod, Fundstrat, he's the chairman of this company called Bitminer. Do you know anything about this?
Yeah, Bitmine.
All right. So explain, basically they buy ETH and then they stake it. So this is a company that I think at one point had ETH holdings of maybe like 10 billion or I don't know, something more than that, because I remember reading last week that they're down with ETH when it was 1900, they were down like $7 billion on that.
Right.
So last year, I think I read this correctly, that staking Ethereum with whatever their holdings were, they made $188 million. How is that a good business? How does a treasury company that makes its money by staking?
So it's like, it's a little bit dishonest in my opinion, because it's sort of how like in traditional finance, you think about nominal yield versus real yield. So if you own US dollars and you're holding US dollars, you should buy treasuries, because that's like your risk-free yield. And if you're missing out on the risk-free yield, you're losing that value in theory. Ethereum staking is very similar, where if you hold Ethereum and you plan to hold Ethereum for a year or longer, you should always stake it, because if you don't stake it, Ethereum inflates at that rate. And so the value kind of, so it's essentially like nominal wise, yes, they're making that amount, but in terms of like real yield, they're flat. Right. Versus if they didn't stake it, real yield would be negative, if that makes sense.
All right. So you think Ethereum and Solana are overvalued. Are you not excited about the things that are built on their rails?
No. And I think that there's an important difference that needs to be made there, where you can be excited about Ethereum, the technology, or Solana, the technology, without being excited about the token price, and consider Ethereum to be a good investment over some time horizon, right? I think that, I think that's the clear issue with a lot of, with like, in my opinion, Tom Lee's thesis is that he's excited about the technology and he's excited about stable coins, which are all very true. But does that mean that Ethereum is fair valued at $240 billion? And is that going to outperform other investments out there? I personally think that's like a crazy take, right? I think it's extremely unlikely. I don't see a reason for that. Similar thing with Solana. Like there have been many great apps on Solana, which like Pump Fund, for example, which made about $1 billion in their first year of net income. Small team. There's been like a lot of great innovation going on over there as well. But again, it's like, does that mean that Solana, the token, should be worth $50 billion? I don't think so. Right. So I think you can be excited about the technology, but that might not necessarily mean that the token is, worth what it's worth, if that makes sense.
Okay. So you're not a buyer of any of those things.
Okay. I'm not.
All right. So you told me this the other day when we were talking, that Hyperliquid is a disproportionate amount of your investable capital. I just heard Michael talk about it. It was way over my head. You obviously are very schooled in it. Why is this such a concentrated position? You detailed what comes back into the hype coin. Is it very unique relative to a lot of other crypto tokens or crypto businesses?
Absolutely. So kind of what Michael was speaking about earlier, they started with a product first and then built the chain second, which is a very unique way of going to market with a chain. Solana built a chain and then they were like, hey guys, build applications on top and bring us the users, right? Same thing with Ethereum. Ethereum built the chain and similar deal. Hyperliquid built the exchange, the Hyperliquid exchange, which is a decentralized exchange where you can trade perpetual swaps, which is a derivative on Bitcoin, Ethereum, any cryptocurrency. You can trade spot cryptocurrency as well. And then you can, as of recently, trade tokenized equities, equity indices, commodities, FX, that sort of thing. And so they took a really unique approach where they built and kind of created this distribution first, and then they kind of built the chain second. And again, perps is 80% of all the crypto trading volume.
Just explain perps for really quickly.
Sure.
Don't go too deep.
Yeah. So the perpetual future was kind of invented. It was invented a long time ago. It was theorized by economists and stuff, but it really kind of came into effect and became popular in 2016 with BitMEX. Arthur Hayes, popularized the.
He used to come on our show.
Yeah,
but weren't they offering like 100-to-1 leverage?
Well, that still exists today. There are venues where you can trade up to 1,000-to-1 leverage. Actually,
just don't do that. People at home, PSA, don't.
Yeah, it's pretty absurd.
Yeah.
But the perpetual future is essentially it's a futures contract. It's a derivative, so it tracks the price of the underlying, but as opposed to a deliverable future, like a dated future, the way that it tracks the underlying spot price is through a funding rate. And so if the perpetual is above the spot price, there's a positive funding rate, which means it incentivizes people to short and bring the price back down. And then
it's likewise, basically delta hedging.
Exactly, yeah. And so it tracks the underlying that way.
All right, so why is this like the one thing that you want to own in all of crypto?
So on a market cap basis, Hyperliquid trades at roughly a 10x price to earnings multiple. And that's...
Is it one of the very few crypto tokens that you can actually put a price to earnings multiple in?
Yeah, absolutely.
So it's going to attract the sort of investor, maybe a technology investor who could run this through the same sort of models that they do with some of their equities?
Absolutely. Okay. And so where it gets interesting is, again, it's trading at 10x price to earnings now. They're growing double-digit % month over month. Again, perpetuals just for crypto assets is about a $20 billion per year fee opportunity. Hyperliquid currently has about 6 to 7%, depending on the day of that market. Which again is growing at double-digit % every single month, and so that in itself, right? If they're able to continue to grow at the pace they are and become a larger percentage of that $20 billion pie, that's a growth story on itself. But I think what gets really interesting is they've started to list traditional assets via perpetuals. You can trade again NASDAQ, S&P, you can trade NVIDIA, you can trade Google, you can trade silver, gold, all those different things. And the growth for those markets has been very impressive as well.
Why would somebody trade a perpetual future on NVIDIA relative just owning the stock? Because it's going to be this sort of thing where it goes up a little bit, you sell it, goes down a little bit, you sell it. So it's nonstop delta hedging. And how do you take advantage of, let's say, longer term appreciation if that's the mechanism in which you're just scalping?
Right. I think that it's, again, like the perpetual future, the big unlock is capital efficiency because you're able to go long NVIDIA at 10x leverage, for example.
Okay.
And so capital efficiency is the big reason that you might use perps to trade. So let's say you have an opinion on earnings and you want to be long into earnings because you have some opinion there. The perp is probably the best way to express that view. A similar thing for silver or gold, right? It's that kind of thing. You wouldn't hold a perpetual future for several years, just like you wouldn't hold a dated future.
Right. So it's just a trading vehicle.
It's just a trading vehicle. Exactly.
All right. So you just made a great case to me, not investment advice again, why you are long hype, why it's a disproportionate amount of your investable capital as it relates to crypto. You detailed their business model. I think that was all interesting. And from an equity investor perspective, it's probably one of the few crypto assets that you can look at and value not too dissimilar that you would a company or something like that. Okay, so why have other crypto investors not appreciated this? It's off its highs considerably, right?
Yeah.
Like a lot of other cryptos. Is it correlated to Bitcoin?
So for a while it was, and it's interesting because as of about like 2 weeks ago, it's really like broken those correlations. So Bitcoin over the past 2 to 3 weeks is down about 20 to 25%. Ethereum's down about 30%. Solana's down 30%. Hype is actually up 30%, 35% in that same time period. And so obviously the correlation has switched a bit. And I think, again, a big reason for that is because their revenues are diversifying into traditional assets. Like I was talking about earlier, they have perpetuals listed for single stocks, indices, commodities, foreign exchange, that sort of thing. And it's becoming a very large aspect of their daily volumes. So I believe there was a day about a week and a half ago where Hyperliquid made up for about 3% of the total global silver futures volume. Like that's including CME and all the traditional exchanges. They processed about $5 billion in 24 hours of their silver perpetual contract. And so what gets really interesting and the real growth story outside of this kind of $20 billion a year crypto bubble of fees for perpetual swaps, it's if they're able to capture market share in traditional assets. So Hyperliquid Strategies, which is the ticker PER, it's kind of their treasury company, had their earnings a few days ago, and they put out a really interesting presentation.
Wait, what's the treasury company called?
It's called Hyperliquid Strategies.
Okay.
Ran by Mr. Bob Diamond. Tickers PER. Yeah,
we talked about it. So Atlas, and he was like a big mocker banker back in the day for decades.
Yep.
It's interesting.
So they just had their earnings a few days ago, and they laid out a really interesting presentation where they showed if Hyperliquid's able to capture 20 basis points of the total notional volume traded between equities, commodities, foreign exchange, that sort of thing, their revenue would 4x. And if they're able to capture 50 basis points of those markets, their revenue would roughly 8 to 9x. So that's the real story here, is that they've managed to attract a ton of customers in the crypto sphere, growing from basically no market share to 7% of the total perpetual swap market share in crypto. And then the real story is if they're able to break into traditional financial instruments, if they're able to capture 20 bips, their revenue is 4x. If they're able to capture 50 bips, the revenue is 9x.
All right, just by the way, you convinced me. Michael also, and I went to go buy it on Robinhood, and I can't. It says that in New York State, you can't buy it. And then if you've been in New York State for 45 days, if you're out of the state, you can't buy it. So we're going to look into that. I don't know why. I know you already own it. So, we're not going to talk to people how they can buy it in New York State if they don't. Does VPNs work and stuff like that or no?
I'm not sure. I'm not a VPN user.
Yeah, well, you've been outside of New York State a bunch, and that's obviously how you accumulated the position. All right. I really appreciate you coming here. Very interesting stuff. I hope you'll come back. We'll do an update on Hyperliquid and see if your mind changes on the Bitcoin, the Solana, or the Ethereum. Evan Karvounis, I really appreciate you being here.
Yeah, thanks for having me. I appreciate it.